Hello, this is Steve St. Angelo from the SRS Rock Report, and I'm really glad you're joining me today. We're going to talk about one of my favorite subjects, that's silver. Actually, we're going to talk about $40 silver, which we just surpassed for the first time since 2011, which I believe is just the beginning, and why we're going to see much higher silver prices coming. Now, in this report, I'm going to talk about the main factor that's missing in the precious metal industry about the coming silver bull market. Now, I'm going to start here. This is the silver price on the quarterly chart, and a quarterly chart shows 3 months of trading. And we've never seen a close above 40 on the silver quarterly chart ever. Now, if you look at that 1980, that long red candlestick, that is showing the opening on the quarterly chart when silver opened on 1980 on January 2nd at $39.95, went all the way up almost to 50, and then it came all the way down. So we've never seen a break and close above 40. And if we get a break and close above 40 on a quarterly basis by the end of this quarter, which is at the end of September, or in the future, that's when we're going to see much higher silver prices. But this is only the short term. Now, talking about price forecasts, I want to first start here. The problem with inflation-adjusted price spikes, because analysts are trying to give an idea of what the gold and silver price should be now or in the future. And the problem with using price spikes, and if you look at this, the chart with the gold, it's showing when gold hit a high of $850 in 1980, and according to CPI, inflation adjusted, it should be almost 34,000. And if you look at the right side, they're going by the peak of $50 in 1980. Well, based on inflation, it should be almost $200. The problem with this analysis is you can't go by price spikes. You have to go by the fundamental, the cost of production. And that's what I want to show here. But these are the price spikes of silver. It reached $49.45 in 1980. It hit $49.85 in 2011. And so investors want to see, why are we hitting $50 again? Now, we just hit $42.29. That was December futures contract. But I'm going to explain what these red values shown in the chart mean. But why we go by the cost of production? Well, to give us an idea of what the prices should be, an inflation-adjusted price. This is the M2 money supply of the four major central banks. That's the PBOC, People's Bank of China. That's the Bank of Japan, the ECB, and the U.S. Treasury. And since 2000, it was 16 trillion. So look, now it's 95. We've added almost 80 trillion in M2 money supply. And this is only the M2. So we're getting a lot of inflation with the money supply. And then look at the debt. In 2000, the global debt was 84 trillion. It's almost quadrupled to 325 trillion. So all of this money printing, all this debt is impacting our inflation. But if we take all of the money printing, all of the debt increases, my analysis shows the top primary silver miners' cost right now is $26. And this is what we need to base on if we're going to go by inflation-adjusted prices. Now, to get that figure, 26, I took the top primary silver miners: First Nilo, Pan American Silver, Core Mining, Buenaventura, Hecla, First Majestic, and Endeavor Silver. There are other silver miners. There's even byproduct silver production. But the number I got was 2578. That was the average weighted for the group, almost 26. And this has been, if we go back here, we could see the silver price has always gone back down to the cost of production, and that's based on the primary silver miners. Now, if we look at this chart, I've taken 5 different years: 1972, 1980, 2000, 2011, and 2025. Well, in 2025, you can see my cost of production right there in the blue bar and the red bar, 2578. Right now, I go by the average annual prices. We can't go by valleys. We can't go by peaks. We should go by the average annual prices. And right now, the average price in 2025 is $34.58. So the silver miners are making about an $8.80 profit. If you go back to 1972, the price of silver was only $1.68. That was the average price of the year. The miners, it cost them $1.55. That's my estimate. Now, by look at 1980, the cost went up to $9.30 because the oil price went from $1.80 a barrel up to 36. But the average silver price was only $20.65 in 1980, which the miners made $11.35 profit. Then the oil price, we had a recession, the oil prices fell, we had silver prices really fall. In 2000, $4.95, that was the price of silver. Look at the cost, $4.75. And then it increased again to $22.14 in 2011. And we can see that. Now, it makes a little bit more sense. We had the total cost was $9.30 in 1980, fell to $4.75. That was the cost in 2000, and went up to $22.14 in 2011. It did fall again by here in 2016 and 17, but now we're the highest cost ever, $25.78. And this is what we need to go by, because if you look at this price, this is the estimated total silver mining cost. They're the same in the red, versus the high silver price spike. When silver hit $49.45 and the cost was $9.30, look at the margin. Look at the margin, $40.50. So if silver stayed at $50 for the entire year, this is the profit they would have made. They would have made $40 profit. That's 4 times the cost, more than 4 times the cost. And so this is why the price, using price spikes for doing inflation adjustment forecast doesn't work. And the reason why I say that is the whole entire goods industry, global market, is based on cost of production. I'm just going to show you a few here. This is D.R. Horton, home builder, total estimated cost versus their net income, which is in the white. Their costs are in red. Now, D.R. Horton, they're one of they build the more modest homes, a $300,000 home, $350,000 home. But what we see after the global financial crisis, the housing subprime, it fell. We could see that their revenues and their net income fell. They weren't making much money in 2009, 10, 11, but even their profits, as the cost increase, didn't go up that much. They have gone up recently, but look how much the costs are for producing a home for D.R. Horton. It's almost double what it was in 2006. The same is true for producing automobiles. This is Ford Motor Company's total estimated cost in red, and their net income profit margin is in white. What we see here, then they're not making a lot of margins. Their profit margins aren't that high. Now, you'll notice we don't see a big increase in 2024. The reason for that, Ford only produced 4.4 million vehicles in 2024. They produced 6.8 million vehicles in 2005. 2 million less. So the cost of the vehicle is much higher, which isn't shown here. But again, this is what the market goes by. Ford is making some profit margins. They're not making a lot of profit margin, but this is what car costs are based on. And we see the same thing with Pan American Silver. Going back to 2004, the cost for Pan American Silver is in red. They had a nice margin when silver hit 35. That was the average annual price. They had a pretty good margin. It declined, and now it's gone up. But again, this is based on the second quarter. Price of silver now above 41, these margins are much higher. And if we look at Barrick and Newmont, we could see their margins are actually higher than the primary silver miners. We could see in 2011-12, Barrick and Newmont had nice margins. They declined, but then we can see they've gone up again. But look at the cost now for Barrick and Newmont. They have gone up considerably. But what's interesting, if we look at the current gold price at about $3,600, look how high the margin is. Costs have gone up, but the margins have gone up very high. So we're heading into, I think, economic weakness, global economic weakness. We should be prepared. We may see a correction in the metals at some point in time because of these high margins. But going forward, my analysis of the silver and gold prices going forward are not based on the cost of production. So if we're going to go by inflation-adjusted prices, you can't go by peaks. You have to go by the cost of production. That's all I'm trying to say. However, the missing factor moving forward, why I'm a big believer in owning the metals, physical gold and silver, has to do with coming energy constraints. Now, this report that came out a few years ago, they're talking about we're starting to hit peak net energy. This chart basically shows total energy, oil production, liquids production. That includes natural gas, liquids, everything. What they're showing here, this large area on top is the actual oil cost. And all these colored areas, this is the net energy. Even though we're going to continue to see higher overall liquids production increase until after 2030, we've already hit peak net energy. It's plateauing, and it's really going to start to fall off a cliff after 2030. And their analysis, by 2050, half the cost to produce this oil is going to be 50%. And that's we're seeing the collapse in the energy return on investment, which is going to make all of this get into trouble. All the money printing and all the debt. It's all due to the coming energy constraints, especially peak net energy, because that's the energy that we really consume for growth. So it all comes down to this: collateral. This is the energy constraints. The peak net energy is going to impact what's real collateral. Collateral is a valuable asset that a borrower pledges against the security for a loan, serving thus as a guarantee for the lender. And here's some examples of collateral. We have real estate, homes, land, vehicles, cars, boats. Now, financial assets, they include stocks, bonds, savings, and then valuables. In valuables, that's actually gold and silver. That's what they lump as valuables. The problem with peak net energy and peak energy is going to be in the stocks and bonds and financial assets, especially the bonds. Now, why is that important? Because the king bond in the world is the U.S. Treasury. And I spoke about this in my Silver Symposium that I did 2 years ago at the Caesars Palace. The collateral trap U.S. Treasury debt as a foundation to stabilize the financial system. This was a 2016 Bank of International Settlements paper. And what they showed was the problem with all the debt, all the outstanding debt, the U.S. Treasuries had to be the foundation of this debt, of all this debt. Now, why is that a problem? Because U.S. Treasuries are actual another debt. It's not an asset. And you could see this more clearly when we break it down in this chart. This is the estimated total cost for various collateral types, U.S. Treasuries versus gold and silver, based on $100. $100 of Treasuries, $100 of gold, $100 of silver. Now, right now, the average interest rate is about 4%. It could be less. It could be 3.5%. I'm making it 4%. So of the $100 of outstanding Treasuries, the U.S. government, U.S. Treasury has to pay $4 in interest expense. Could be less. Could be $3.5. That's the cost, because it doesn't really cost anything to print a Treasury. It's digital. The cost is in the interest expense, and that is going up. And now, but they can print that interest expense too. The difference between gold and silver, I looked over a 25-year period, and the cost is about 80%. That's the cost to produce gold. The profit is $20, 20% profit. For silver, it's even higher. It's 90% cost, $90. And most of that is all the energy and labor, energy in all costs and all stages. This is what collateral should be based on. Collateral should be based on the energy and the energy value and labor that goes into producing that collateral, like a home. If you have a home mortgage, that home mortgage is the collateral on the home. The cost of the home, let's say it's $350,000. It's all the energy, all the materials from all the energy, the mining, and in the labor that went into producing that home. That's why you could use your home as collateral for a home mortgage or private loan. So going forward, the problems I see now that we're hitting peak net oil energy is the collateral we're used to that is the foundation of the global financial system, U.S. Treasuries. There's really no energy value in it. There's no real energy it took to produce that collateral. So I think going forward, we're going to get in, I think U.S. Treasuries, bonds are going to get into trouble. And the best store of value is going to be in collateral that takes a lot of energy, value, and labor to produce it. And that's gold and silver. Well, if you have any questions or comments, please leave them in the comment section. Thank you.